We go to Jeffery Harte in Chicago with Sandler O'Neill. Jeffrey, good noon to you.
Nice to be here.
What do we need to know? What are you telling your clients right now about the state of the earnings reports we will see near the end of July?
Well, I mean, it's kind of it's a double-edged sword. The second quarter numbers are probably going to be pretty tough. The trading environment has not been very good. Investment banking's held up pretty well, but not enough to offset the trading side. And for banks with pure bank operations, net interest margin contraction continues, loan growth is slow. So second quarter numbers, at least for the money centers and the big investment banks, probably aren't going to be very good. You know, it wasn't long ago we were low on the street in names like Goldman Sachs, but numbers have been coming down pretty quickly.
Right.
But I think it is important to bear in mind, this is the summer. There's a lot of uncertainty. A weak second quarter does not mean we have to have a weak third or fourth quarter.
Okay, I'll buy that, but let's go back to Jeffrey Immelt, who runs General Electric. They have a bit of a financial arm. As I recall, he would say nominal GDP matters and organic revenue growth matters. Where is that organic revenue growth for the banks?
Well, if you're looking at the investment banks, it's certainly in kind of the international capital markets. That's really where we're seeing growth. If you step back to more the pure traditional bank side, yeah, revenue growth is tough. I mean, credit loan loss reserve releases are helping a lot, but the market's really looking for where are you going to grow revenues, and a lot of that becomes a macro call. If the U.S. economy can keep chugging along at something like a 2% growth rate, we can get some revenue growth. If we slow down a lot more than that, it's going to be a problem. But I think it's good to be looking at something like a Citigroup where you get exposure to some of the emerging markets and the international markets,
right,
where you still got very good growth going on. Because the U.S. certainly on the lending side is facing some pretty tough growth headwinds.
Let's look at dreaded first chart. Bring it up here. This is short term. We usually look at the Keith Bruyette index out, 5 years, 10 years. Here it is short term. If we look at BKX, Jeffrey, what a rollover since April. The market ahead of those earnings. What conference call or management meeting have you seen that indicates the third quarter could be better?
Well, I mean, what we've seen with the bank stocks year to date in 2011 is really, I think, three things going on. One, we're seeing signs that the economy is slowing. The data's been pretty clear. That's brought investors to shift from cyclical names to defensive names, and financials are very cyclical. So kind of the macro backdrop hasn't been real favorable. But you've also got a lot of uncertainty around capital levels and some of the regulatory changes, coupled with what's been a pretty tough environment here. But specifically, when you start talking about some of the commercial businesses, and specifically investment banking, trading, kind of the investment banking fortes, those are very volatile businesses, and the second quarter is almost always weak. So, I mean, if you look to the back half of the year for the investment banks, you've got to be looking at, will economic growth be okay, or are we really heading to a double dip? But I think, at least my personal opinion is, a lot of the slowdown we've seen has been Japan. I mean, that's a big supply chain disruption, which will come back. And I think we'll start seeing those numbers, in July, August, kind of moving back the right way, and that'll give investors some comfort.
Here's a chart that surprised me. Jeffery Harte lives this chart each and every day. 4 major banks, 2 outcomes. It's an elegant chart. And let's explain this. Goldman Sachs, JP Morgan, normalized back to 2006. So we start them all at the same point 5 years ago. And you've got 2 banks. Goldman Sachs wasn't a bank at the time, I believe. JP Morgan and Goldman Sachs in white and yellow. And look at the 2 dogs down below, I guess red, white, and blue. Citigroup in red and Bank of America in blue, showing their tough 5-year path. You mentioned Citigroup, Jeff Harte. Do you want to buy the apparent 5-year value, or do you want to go with Mr. Diamond and Mr. Blankfein?
Well, I think the attractive thing to Citigroup is exactly that. People that owned it got burnt by it, and there's a lot of, I think, emotional resistance to want to look at a Citigroup. But looking at it today, their balance sheet is, in my opinion, in as good a shape, if not better, than anyone else's. And you've got some growth potential that you really don't have from some of the banking peers. So I think Citigroup is a compelling story today, but certainly, I mean, the chart shows that people are going to be apprehensive to come back in.
Jeffery Harte with us from Sandler O'Neill. Here's from his research note. Bring this up if you would. Jeff, a recent idea on consolidation, like where is it? Balance sheet uncertainty is a significant deterrent. What are banks' real estate assets and loan books really worth? I agree with you. That's a single distinction here. We see case Schiller tomorrow. It's really about real estate and those further markdowns, isn't it?
That's a big issue for consolidation because whether it's commercial real estate or mortgages, that's a lot of the assets on banks' books. And if you're a buyer, seeing Case-Shiller and some of the indices start going the wrong way on pricing again, and seeing kind of what the appraisal values are coming out after foreclosure on some of the commercial real estate that's not really kind of prime A-list commercial real estate, that's got to give buyers some apprehension as to what the actual assets they're buying are. Now, I think the economy is better than people think. It'll keep moving along. So I don't think we're heading toward a double dip, but it's going to be a pervasive problem, but it's certainly slowing things down right now in an industry that, quite frankly, has a lot of consolidation ahead of it, I think.
Okay, with consolidation, what's your single best buy under category consolidation?
Well, to be fair to myself, the banks I cover aren't going to be the buyers, the Citigroups, the JP Morgans, the Bank of Americas. But so, I mean, that becomes a bit of a roll the dice. Which one do you think will be taken out, won't be? But I think kind of approaching it from a basket perspective of taking kind of a number of banks that are likely to be maybe some of the stronger buyers might be a nice way to play it, because it just kind of looking at the U.S. versus the rest of the world, we're awfully heavy banks here.
Rip up the script. Jeffrey, Bloomberg Business Week this week with a great chart showing how JP Morgan needs to build into Florida. Did they acquire to build into Florida, or do they do that organically, bank by bank?
I think they're going to pursue it organically, at least in the near term, but they're definitely looking for opportunities there, because I mean that's
We'd like
the one
to know
kind of
one.
hole in
Come
their
on,
footprint.
we want to know one. Give us a Florida bank that says Diamond.
There's no surprises as to the franchises that are large enough down there to be interesting enough to JP Morgan. It's the SunTrusts. I mean, the names aren't surprises. It's a matter of whether it kind of comes to terms that Jamie Dimon is willing to take, because he's going to be a price-sensitive buyer, in my opinion.
Note of the day, he lives in Florida with Rockdale Securities. Richard X. Beauvais. Bring up this note. I love this, Jeff Harte. Let's think about this. The approach is to stimulate economic activity by cutting money supply, increasing interest rates, eliminating fiscal stimulus, and raising taxes. That should work, maybe. Okay, there's Dick Beauvais with sarcasm extreme on this government. Jeff Harte, what does the banking industry need from the government of the United States right now?
Well, I think two separate things. One is just on a macroeconomic basis, we need some certainty coming out of Washington so the economy can grow. I think employers are hesitant to hire because they don't know exactly what health care will be under Obamacare. We don't know if the tax breaks are going to be continued for another year or not. There's just a lot of general uncertainty weighing on the economy. Specifically for banks, we need to get to a point where we know what the capital requirements are, especially for the big banks, the SIFI buffers. I mean, we need to start getting some of these rules written so the banks can start reacting and it's less uncertainty. Because if there's anything Wall Street likes less than bad news, it's uncertainty. And right now we're swimming in uncertainty.
Let's listen to Liam Dalton. Earlier this morning, Bloomberg Surveillance, Sirius and XM 113. I spoke with Liam Dalton of Axiom Capital, and I asked him if he thinks the media, if Tom Keene is overplaying the economic slowdown, is it noticeable on Wall Street?
Wall Street's in a very tough spot right now. And frankly, with the profit model changing, if you're managing a large or medium-sized investment bank, what you have is you have a shifting business model, and all you can really do is take cost out because the top line is coming down. Right now, they're actually in contraction mode. They're taking product lines out. So it's hard for investment banks, and it's not a short-term issue.
Liam Dalton there, and Jeff Harte, to go back to Citigroup, which I think people are fascinated by trading, post-reverse split, $4 a share. What a train wreck. What is Vikram Pandit doing to win in that hyper-competitive Asia?
I think one of the things he's doing is taking his time and doing things right. Their results are getting better and better, which is good, but they're not reaching out beyond themselves. They're kind of doing things consistently, and it may be a slow story unfolding, but their consumer presence and to some extent their commercial presence internationally is really unmatched, and we're seeing good results out of it. Loans are growing, yields are higher, credit keeps getting better. I think it proves itself out over time.
Yeah,
what you don't want to do is start reaching to try and make it work tomorrow.
Rex, get out of the hammock and put up a chart of Citigroup if you can. Just, figure out something that you can do. Jeff Harte, you sit at the peninsula in Kowloon, and you look across at that skyscraper that says Citibank on it. they were really there first of the U.S. banks, weren't they?
Yeah, I mean, they were one of the leaders internationally, and they still are. But I think what that maybe weighs a bit on the stock, though, because the core Citigroup story of expanding with the emerging markets and that unique footprint isn't new. I mean, we were talking the same things with Sandy Weil, over a decade ago. They've been delivering finally again now, but I think investors are kind of skeptical because that story really hasn't changed. It's become a matter of execution.
Okay, here's a Citigroup's chart as we go out. Thank you so much, Jeffery Harte. Really appreciate it.